Before we dive in, it is critical to understand that the information provided in this presentation is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or credit professional. This video is not intended as a substitute for professional financial advice. The mortgage and credit industries are complex and subject to change. Always consult with a qualified professional who can assess your individual situation before making any financial decisions. Imagine this for a second. You find it, the perfect house. It has the backyard for the dog, it's in the right school district. You can already see yourself hosting Thanksgiving dinner there. You've worked for years, scrimped and saved every penny for that down payment. You have a good stable job. You walk into the bank, confident, ready to take the biggest step of your life. And the loan officer slides a piece of paper across the desk with an interest rate that makes your stomach drop. Or even worse, they look at you with that sympathetic half smile and say, "I'm sorry, we can't approve this right now." What just happened? In almost every case, the silent saboteur, the invisible barrier that just cost you your dream, was a single 3-digit number. Your FICO score. Here's a fact that should stop you in your tracks. On a typical 30-year, $400,000 mortgage, the difference between a good FICO score and an excellent FICO score can be over $60,000. That's not a typo. $60,000. In extra interest payments. That's a luxury car. That's a full college fund. That's life-changing money. All dictated by a number that most Americans find completely mystifying. And that's the core problem, isn't it? This number holds immense power over our lives. It dictates the single largest purchase we will ever make. Yet it operates like a black box. It feels arbitrary, unfair. We're told to pay our bills on time, but the real mechanics of how the score is calculated, what lenders actually look for, and how to strategically improve it remains a closely guarded secret. It leaves you feeling powerless, like you're playing a game where you don't know the rules. Well, that ends today. This video is the rule book. This is your blueprint for taking back control. We are going to pry open that black box and demystify the entire FICO score system as it relates to your mortgage application. By the time you're done watching, you will not only understand what your FICO score is, you will understand the psychology behind it. You will know exactly how mortgage lenders view your score, what specific thresholds they look for, and most importantly, you will have a clear, actionable game plan to optimize your score and save yourself tens of thousands of dollars. We are turning you from a passive participant into an active, educated player who can command the best possible terms for your home loan. So let's start at the beginning. Think of your FICO score as your financial reputation distilled into a number. It's a snapshot, a summary of your entire history as a borrower. It tells lenders a story about your relationship with debt. Are you reliable? Are you responsible? Or are you a risk? Before this system existed, getting a loan was incredibly subjective. It often depended on your personal relationship with a local banker. He'd look at your income, your assets, and maybe even the kind of car you drove and make a gut decision. This was inefficient for banks and often led to unfair, biased lending practices. Then in 1956, a company was formed called Fair, Isaac & Company. You see it now? FICO. Their goal was to solve this problem by creating a standardized, objective, data-driven system to predict a borrower's likelihood of repaying a loan. They spent decades analyzing millions of anonymous consumer credit files to find patterns. They identified specific behaviors and data points that correlated strongly with a person defaulting on their payments. The result was the FICO score, a mathematical algorithm that could instantly assess a person's credit risk. For banks, it was a revolution. It allowed them to make faster, more consistent, and more profitable lending decisions. For you, the consumer, it means you're being judged not by a person's opinion, but by the story your data tells. And understanding that story is the key to everything. Before we get into the nitty-gritty, let's kill a major myth right now. The myth that checking your own credit score hurts it. This is flat out wrong. When you check your own score through a credit monitoring service, a free provider, or your credit card company, it's called a soft inquiry, or a soft pull. You can do this every single day, and it will have zero, I repeat zero, impact on your FICO score. It's only when a lender pulls your credit as part of a formal application for new credit that a hard inquiry is recorded, which can have a small, temporary impact. So please do not be afraid to know your number. Flying blind is the most expensive mistake you can make. Now, how does this FICO algorithm actually work? What is it looking at? While the exact formula is a proprietary secret, more valuable than the recipe for Coca-Cola. FICO is very transparent about the ingredients. They've broken it down into 5 main categories, each with a different weight. First, and by far the most important, is your payment history. This accounts for about 35% of your score. It's the heavyweight champion. Do you pay your bills on time? Every single time? A single late payment can wreak havoc on your score for years. Second is amounts owed, or what's often called your credit utilization. This is worth about 30% of your score. This isn't just about how much debt you have in total. It's about how much of your available credit you're using, especially on revolving accounts like credit cards. Third is the length of your credit history, which makes up 15%. The longer you've been responsibly managing credit, the better. This is why you should think twice before closing your oldest credit card account. Fourth is new credit, accounting for 10%. This looks at how many new accounts you've recently opened and how many hard inquiries you have. Opening too many accounts in a short period can look like a red flag to lenders. And finally, fifth is your credit mix, also worth 10%. Lenders like to see that you can successfully manage different types of credit like a car loan, a credit card, and maybe a student loan. 35, 30, 15, 10, and 10. That's the recipe. Every single financial decision you make that involves credit, every swipe of a card, every loan payment, is being filtered through these 5 categories and used to update your score. Now let's put ourselves in the shoes of the mortgage lender. Why do they care so deeply about this one number? The answer is one word: risk. A mortgage is often the largest loan a bank will ever give an individual. They are betting hundreds of thousands of dollars that you will pay them back with interest consistently for the next 30 years. Your FICO score is their #1 tool for predicting the future. It's their crystal ball. A high score tells them that, based on your past behavior, you are a very low risk. You are a safe bet. And because you're a safe bet, they are willing to compete for your business by offering you their very best interest rates. A low score, however, screams risk. It tells them there's a statistically higher chance you might struggle to make payments or even default on the loan entirely. To compensate for that extra risk, they have no choice but to charge you a much higher interest rate, or in some cases deny the loan altogether. It's not personal, it's just math. It's a business decision based on a risk assessment. So, the entire game of getting the best mortgage is about proving to the lender, through your FICO score, that you are the safest possible bet. It's about polishing your financial reputation until it shines. But what are the actual score ranges that matter? What's the real-world difference between a 670, a 720, and a 780 in a lender's eyes? These aren't just random numbers. They are specific tiers that unlock completely different financial worlds. Understanding these tiers is the first step to playing the game to win. Let's put you in the underwriter's chair for a moment. Imagine 3 folders land on your desk. Each is for a $300,000 mortgage on an identical house. The only significant difference is the FICO score printed in bold on the cover. The first says 670, the second, 720, the third, 780. To an outsider, these are just numbers. To you, the underwriter, they are 3 entirely different stories, 3 completely different levels of risk. And you're going to treat them accordingly. This is the reality of credit tiers. They are the invisible velvet ropes of the financial world. Your score doesn't just get you a yes or a no, it determines the quality of that yes. It dictates the price you will pay for the exact same product, money, for the next 30 years. Let's start at the bottom and work our way up. Generally speaking, any score below 620 is considered the subprime, or poor, credit tier. If a 670 score is a yellow flag for a lender, a 590 is a blaring red siren. In this range, getting a conventional mortgage, the kind most people talk about, is next to impossible. The statistical models that banks live and die by are screaming that there's a high probability of default. It's not personal. It's a cold, hard calculation of risk. Now, does this mean homeownership is completely off the table? Not necessarily. This is where government-backed loans like an FHA loan often come into play. They act as a sort of safety net, designed to help borrowers who don't fit into the conventional box. But this safety net comes at a steep price. You'll face a mandatory, expensive form of insurance called mortgage insurance premium, or MIP. Unlike its conventional cousin, PMI, FHA's MIP often stays with you for the entire life of the loan. You're paying a premium every single month for decades because your score signaled high risk at the very beginning. Getting a loan in this tier is possible, but it's the most expensive and restrictive path to homeownership. Now let's climb the ladder into the next tier, which we can call the fair, or gateway tier. This is roughly from 620 to 679. That 670 score from our example sits right here. This is a critical threshold. A 620 is often the absolute minimum score many lenders will even consider for a conventional loan. Crossing that line means you're officially in the game. But you're playing on the hardest difficulty setting. When a lender sees a 670, their posture changes from no to maybe, but. The but is where it gets expensive. You will be subject to what's called risk-based pricing. Think of it like car insurance. A 16-year-old with a new license pays a fortune for insurance because the data shows they are a high-risk driver. A 40-year-old with a perfect driving record pays a fraction of that. It's the same car, the same roads, but a different price based on perceived risk. Mortgages work the exact same way. With a 670 score, you're the 16-year-old driver in the lender's eyes. You'll get a higher interest rate. You'll be required to pay private mortgage insurance, or PMI, and your PMI rate will be higher. Your application will be scrutinized more heavily. The underwriter will ask for more documentation, more letters of explanation for every little blip on your credit report. You can get the loan, but the lender is pricing in the risk that you might not pay it back. You're paying a penalty for your past financial behavior. Let's move up again into the good credit tier. This range is typically from 680 to about 739. Our 720 score lands squarely in this zone. This is where the financial world begins to open up. A lender sees a 720 and the story changes. This applicant is no longer a high-risk teenager. They're the reliable 40-year-old driver. The data shows that people in this range are significantly more likely to pay their mortgage on time, every time. The result? The entire dynamic shifts. Your interest rate drops. That's not a small thing. Even a quarter or a half a percentage point difference is enormous over 30 years. Your PMI costs will be substantially lower because the insurer also sees you as less of a risk. The underwriting process becomes smoother. You might find you have more loan options available to you, perhaps with better terms or lower closing costs. You're not just getting a yes, you're getting a better yes. You've moved from the penalty box to the preferred customer line. And now we arrive at the top, the excellent or elite tier. This is anything from 740 upwards. Our 780 score is a platinum card of entry into this club. When a lender sees a 780, the power dynamic flips completely. They are no longer doing you a favor by lending you money. You are a prize. You are a low-risk, high-value customer that they want to win. Lenders will actively compete for your business. At this level, you are offered the absolute best interest rates, the rock-bottom prices. Your PMI will be the lowest possible rate, and if you have a decent down payment, you may be able to avoid it altogether with certain loan products. The entire process becomes faster, simpler, and less stressful. You have negotiating power. You have options. You are in control. A 780 score doesn't just tell a lender that you're reliable. It tells them you are in the top echelon of financial responsibility. So what does this all mean in real dollars and cents? Let's go back to those 3 folders on the underwriter's desk. Let's assume it's a $400,000 loan. The applicant with a 670 score might get an interest rate of, say, 7.25%. Their monthly principal and interest payment would be about $2,728. On top of that, because they are seen as higher risk, their PMI could be around $200 a month. So their total monthly housing payment is $2,928. Now the applicant with the 720 score. Because they are in the good tier, they get a better rate, maybe 6.75%. Their monthly principal and interest payment is now $2,594. Their PMI is also lower, perhaps $120 a month. Their total payment is $2,714. Just by moving up one tier, they are saving $214 every single month. That's over $2,500 a year. But what about the applicant with the elite 780 score? They get the VIP treatment. The lender offers them their best rate, let's say 6.25%. Their monthly principal and interest payment drops to $2,462. Their PMI is a bargain, maybe only $70 a month. Their total payment is $2,532. Let's compare the two ends of the spectrum. The person with the 670 score is paying $2,928 a month. The person with the 780 score for the exact same house is paying $2,532. That is a difference of $396 every single month. That's nearly $400 that could be going towards investments, college savings, or just living a better life. And it gets even more staggering when you look at the big picture. That $396 difference per month, over the 30-year life of the loan, adds up to $142,560. Let that sink in. $142,000. That's the price of a luxury car. It's a full college education. It's a significant portion of a retirement nest egg. All of it lost or gained, based on a 3-digit number that many people don't fully understand. These tiers aren't just suggestions. They are the fundamental rules of the mortgage game. Understanding where you stand is the first step. But the real power comes from knowing how that all-powerful number is actually built. What are the secret ingredients that FICO uses to judge your financial life? It's not magic, it's a very specific formula. And understanding that formula is the key to taking control. So let's break down that formula. Imagine your FICO score is a pie, and it's divided into 5 slices, each one a different size, and each one representing a different part of your financial life. Some slices are huge and some are just slivers. But together they create the full picture a lender sees. The biggest, most important slice of that pie, making up a massive 35% of your entire score, is your payment history. This is the heavyweight champion. It is the single most influential factor, and it answers the most fundamental question a lender has. If I lend you money, will you pay it back on time? It's your financial report card, plain and simple. Every on-time payment you make on a credit card, a car loan, a student loan, or a previous mortgage is a big shiny A+. Proves you're reliable. But a late payment? That's a big red F. And the later it is, the worse the grade. A payment that's 30 days late will hurt your score. A payment that's 60 days late will hurt it even more. And if you hit 90 days late, the damage becomes severe. This category also includes the really heavy stuff. Things like collections, charge-offs, foreclosures, and bankruptcies. These are the nuclear bombs of your credit report, and their impact can last for 7 to 10 years. A single late payment from 3 years ago can still be dragging your score down today. This is why the advice you hear over and over again, pay your bills on time, isn't just friendly guidance. It's the absolute bedrock of a good credit score. Nothing else matters if this piece is broken. Now, the second biggest slice, and this one is almost as big as the first, is worth 30% of your score. This category is called amounts owed, but that name is a little misleading. It's not just about how much debt you have in total. It's about how much debt you have in relation to your total available credit. This is your credit utilization ratio, or CUR, and it is critically important. Let's make it simple. Imagine you have one credit card with a $10,000 limit. If you have a balance of $3,000 on that card, your credit utilization is 30%. You're using 30% of what's available. If you have a balance of $9,000, your utilization is a sky-high 90%. Here's how a lender sees it. Someone with low utilization, say under 10%, looks like a fantastic manager of their finances. They have access to credit, but they aren't dependent on it. They're in control. But someone with high utilization, someone who has maxed out their cards, to a lender, that person looks like they're living on the edge. It signals financial distress. It suggests that they might not have enough cash flow to cover their expenses, and one small emergency, a car repair, a medical bill, could push them over the brink and into default. This is where one of the biggest myths in personal finance lives and breathes. You've probably heard it. You need to carry a small balance on your credit cards from month to month to build your credit score. This is 100% false. It's a lie that costs Americans millions of dollars in interest payments every year. You do not need to pay a single penny in interest to have an excellent score. In fact, the people with the highest scores, the 800+ club, do the exact opposite. They use their cards, but they pay the statement balance in full, on time, every single month. They get all the benefits of building a positive payment history without ever paying interest, and they keep their credit utilization ratio incredibly low. Remember, FICO can't see if you pay in full or just the minimum. It only sees the balance that gets reported by your bank once a month. So keeping that reported balance low is the key. So between payment history and amounts owed, we've already accounted for 65% of your entire FICO score. If you master just these two things, paying on time every time and keeping your credit card balances low, you are already well on your way to a fantastic score. The next slice of the pie is smaller, but still significant. At 15%, we have the length of your credit history. Time is a key ingredient in the recipe for trust. A lender wants to see a long-established track record. They're more comfortable lending hundreds of thousands of dollars to someone who has successfully managed credit for 15 years than to someone who just got their first credit card 6 months ago. This category looks at a few things: the age of your oldest account, the age of your newest account, and, most importantly, the average age of all your accounts combined. A longer history provides more data for the FICO model to analyze, giving the lender more confidence in the score's prediction of your future behavior. This is precisely why the common advice is to avoid closing your oldest credit card, even if you don't use it much anymore. That card acts as an anchor for your credit age. Closing it can shorten your credit history and potentially lower your score. Think of it like a long-term relationship. The longer you've proven yourself to be a reliable partner, the more trust you've built. Now we get to the two smallest slices of the pie, each weighing in at 10%. First up is credit mix. This is all about diversity. The FICO model likes to see that you can successfully manage different types of credit. There are generally two main categories: revolving credit and installment loans. Revolving credit is where you have a credit line you can borrow from, pay back, and borrow from again. Think credit cards and home equity lines of credit. Installment loans are fixed loans with a set number of equal payments over a set period of time. Think mortgages, auto loans, and student loans. Having a healthy mix of both shows a lender that you're a sophisticated and responsible borrower. It's like having a balanced financial diet. However, and this is a big however, you should never ever go out and get a loan you don't need just to improve your credit mix. This is a small 10% piece of the puzzle. The potential negative impact of taking on unnecessary debt far outweighs the tiny potential benefit to your score. It's a seasoning, not the main course. And that brings us to the final 10% slice: new credit. This category looks at your recent quest for credit. Every time you formally apply for a new loan or credit card, it typically results in a hard inquiry on your credit report. One or two inquiries here and there isn't a big deal, but a flurry of them in a short period of time? That's a red flag to a lender. It can make you look desperate for cash, or like you're about to take on a mountain of new debt. This is why it's not a great idea to apply for 3 new store credit cards at the mall and a new car loan the month before you apply for a mortgage. Opening several new accounts in a short time can also lower your score temporarily for another reason. It reduces the average age of your accounts, which we just discussed in the length of credit history section. The FICO algorithm sees this pattern of rapidly opening new accounts as risky behavior. It prefers slow, steady, and predictable actions over a long period of time. It's a marathon, not a sprint. So there it is. That's the secret formula: 35% payment history, 30% amounts owed, 15% length of history, 10% credit mix, and 10% new credit. It's not a mystery black box. It's a calculated, data-driven assessment based on these 5 specific areas of your financial behavior. Every move you make, every bill you pay, every balance you carry, every loan you apply for, fits into one of these 5 categories and either helps or hurts you. Understanding this blueprint is the first giant leap toward mastering your financial future. Because now, you don't just know that a high score is good, you know exactly what actions build that high score. But this knowledge leads to an even more important, more practical question. Now that you know how the score is made, how do you find out what your score actually is? And with all the different free credit score apps and websites out there, how do you know if you're looking at a real FICO score, or just a cheap imitation, what we call a FICO score? Because when you're applying for a mortgage, the number your lender pulls is often very different from the one you see on your phone. And that difference can cost you thousands. Let's pull back the curtain on this multi-billion-dollar industry. The score you see on your free credit app? The one you get from your credit card company? 99% of the time, that is not the score your mortgage lender will use. It's not even the same type of score. Think of it like this: you want to buy a Coke. You know what a Coke tastes like, what the can looks like, everything. But the store only sells cola soda. It looks similar, it tastes kind of the same, but it's not a Coke. That's the difference between the score you see and the score the lender sees. The free scores you get online are almost always something called a Vantage score. Vantage score was created as a competitor to FICO by the 3 major credit bureaus themselves: Equifax, Experian, and TransUnion. They wanted a piece of the credit scoring pie, and it's a perfectly legitimate score. It's great for educational purposes, for tracking your credit health month to month. But for a mortgage, it's cola soda. Lenders want the real thing, the name brand FICO. Why? Because the entire American mortgage system is built on it. Fannie Mae and Freddie Mac, the 2 giant government-sponsored enterprises that buy up most of the mortgages in the country, explicitly require lenders to use specific FICO score models, not VantageScore. So if a lender wants to be able to sell your loan, which they almost always do, they have to play by FICO's rules. This is where the real shock comes in. Because not only do they have to use a FICO score, they have to use a FICO score model that's practically a dinosaur. Imagine you spent months, even years, getting your financial life in order. You paid down your credit cards, you never missed a payment, you watched your score on your banking app climb and climb. It finally hits 780. You're ecstatic. That's excellent credit. You feel confident, you feel ready. You walk into a lender's office, fill out the application, and give them permission to pull your credit. You're expecting to be offered the best interest rates, the lowest fees. A day later, the loan officer calls you. He says, "Okay, we've got your credit report back. Your middle score is a 738. You'd stop dead. 738? You think it was a mistake. You check your app again. Nope, still says 780. What happened to those other 42 points? Did they just vanish into thin air? And what does he mean by middle score? Those 42 points didn't just disappear. They were never there to begin with in the eyes of the mortgage lender. You were looking at a modern score, likely a VantageScore 3.0 or 4.0, or maybe a FICO 8 or FICO 9. These newer models are more forgiving. They might ignore small collection accounts or weigh certain factors differently. They're designed to be a bit more reflective of today's consumer. But your mortgage lender isn't living in today. They're living in the late 90s and early 2000s. When a lender pulls your credit for a mortgage, they pull what's called a tri-merge report. This means they get a report and a score from all three credit bureaus: Experian, Equifax, and TransUnion. But here's the kicker. Each bureau's report is run through a different, ancient version of the FICO algorithm. From Experian, they pull your FICO score 2. From Equifax, they use FICO score 5. And from TransUnion, it's FICO score 4. These are sometimes called the FICO classic models. We're talking about scoring models developed decades ago. FICO Score 4, for example, has been around since the 1990s. Think about how much has changed since then. The internet was still a novelty. Most people didn't have cell phones. The way we use credit today is fundamentally different. These older models are much more sensitive to certain things. They can be harsher about carrying balances on your credit cards, even if you pay them in full each month. They can be less forgiving of isolated late payments from years ago. They don't have the nuanced understanding of modern credit data that newer models like FICO 8 or 10 do. They are, in a word, stricter. So the lender gets these three different scores. Maybe your FICO 2 from Experian is a 745. Your FICO 5 from Equifax is a 738. And your FICO 4 from TransUnion is a 730. They don't average them. They don't pick the best one. They throw out the highest score and the lowest score, and they use the one in the middle. In this case, your qualifying score for that mortgage application is 738. That is your real mortgage credit score. Everything else is just noise. And the difference between that 780 you thought you had and the 738 the lender is using is enormous. It's not just a number. It's money. Real money out of your pocket every single month for the next 30 years. That 42-point drop could easily push you into a higher interest rate bracket. 0.25%, 0.5%. It sounds small, but on a $400,000 loan, a 0.5% increase in your interest rate costs you over $43,000 in extra interest payments over the life of the loan. $43,000. All because you were looking at the wrong number. So why? Why on earth would the entire mortgage industry rely on scoring technology that's old enough to have voted in multiple presidential elections? The answer is stability and standardization. Remember Fannie Mae and Freddie Mac? They buy trillions of dollars worth of mortgages and package them into securities to sell to investors all over the world. To do that, they need to guarantee that every loan in that package was underwritten to the exact same standard. They need to be able to tell an investor in Tokyo or London, every mortgage in this bundle was approved using the FICO classic models, and we have decades of data on how these specific scores perform during recessions, during booms, during every kind of economic weather. It's about predictability. They know exactly how a portfolio of loans with an average FICO score 5 of 720 will behave over 30 years. They don't have that same historical data for VantageScore 4.0 or even FICO 10. Upgrading the entire U.S. mortgage industry to a new scoring model would be like trying to change the engine on a 747 while it's in mid-flight. It's a monumental task, costing billions and requiring immense coordination. So they just don't. They stick with what they know, what's been tested, and what's predictable, even if it feels outdated and unfair to the individual homebuyer. This is the single biggest trap people fall into. They optimize their financial behavior to boost a score that doesn't even matter for their biggest financial goal. They celebrate hitting 800 on their free app, not realizing their real mortgage score might be languishing at 750. They're playing the wrong game. And the rules of the real game, the one that actually gets you a mortgage, are hidden, written in a language most people don't understand. So you're left in the dark, armed with a FICO score, walking into the most important financial negotiation of your life. You think you have a straight flush, but the lender's rulebook says you're holding a pair of deuces. This information gap is where mistakes are made. It's where money is lost. It's where the dream of homeownership can get a lot more expensive than it needs to be. The key is to know your real number, not the educational score, not the cola soda. You need to know your FICO score 2, 4, and 5 before the lender does. But how? These scores aren't advertised. They're not available on most free sites. So how do you get your hands on the 3 numbers that actually matter? How do you see what the lender is going to see, and give yourself time to fix any issues before it's too late? The answer is found in one of 2 places. The first is a website that will charge you money, and the second is a person who might cost you a fortune. Let's break that down, because understanding the difference is the key to unlocking the best possible mortgage. First, let's talk about why this is so confusing. Imagine you've been planning a road trip from New York to Los Angeles for months. You've been using a popular free map app on your phone. It tells you the trip is 2,800 miles and will take 42 hours. You budget your gas, book your hotels, and plan your stops based on that information. You feel prepared, you feel confident. Then on the day you leave, you plug the destination into your car's built-in navigation system. And it says the trip is 3,100 miles and will take 50 hours. It's routing you through a dozen small towns the other map completely ignored. Everything you planned is now wrong. You're angry, you're confused. You trusted the map on your phone. It's the most popular one in the world. This is exactly what happens to 99% of homebuyers. They spend months, even years, diligently checking their credit score on free apps like Credit Karma or through their credit card provider. They see a beautiful number, say 780. They feel invincible. They've done the work, they've paid their bills on time, they've kept their balances low. They walk into a mortgage lender's office, puff out their chest and say, "I'm ready. My score is 780. And then the lender swivels their monitor around and shows them 3 numbers. 741 from Equifax, 725 from TransUnion, and 719 from Experian. The buyer's heart sinks. The confidence evaporates. It's a gut punch. They feel lied to. But my app said 780. The lender gives them a sympathetic but tired look. They have this exact conversation a dozen times a day. The free app was showing you a different map. It was showing you a Vantage score or maybe a FICO score 8. Those are great for a general sense of direction. They tell you if you're headed east or west. But a mortgage lender is using a satellite-grade GPS system that tracks every single pothole and construction zone. They are using FICO score 2, FICO score 4, and FICO score 5. These are older, stricter, and far more sensitive models. They are the industrial strength scores built for the single biggest financial decision of your life. They weigh things differently. A single late payment from 3 years ago that your FICO 8 has mostly forgiven might still be a major red flag on your FICO 2. A maxed out credit card, even if you pay it off every month, can hit these older scores like a sledgehammer. The free apps show you the popular, user-friendly map. The mortgage lender uses the official industrial survey map. And your entire financial future depends on knowing what's on their map, not yours. So how do you get their map? How do you see those 3 magic numbers without the shock and disappointment in the lender's office? This brings us to option 1, the website that charges you money. It's a site called myfico.com. And no, this is not a sponsored message. It's just the simple, unvarnished truth. MyFICO is the consumer-facing division of the FICO company itself. They are the people who create the algorithms. Going to them is like getting your car's diagnostic report directly from the engineers who built the engine. When you sign up for their top-tier plan, you don't just get 1 score. You get all of them. You get your FICO 8, your FICO 9, your FICO 10. You get the scores used for auto loans, the scores used for credit card applications. And most importantly, you get the ones we've been talking about, FICO score 2, 4, and 5. The mortgage scores. They will show you the exact 3 numbers from all 3 bureaus that your mortgage lender is going to pull. Now it's not free. It costs about $40 a month. And most people immediately balk at that. $40? To see a number? But let's reframe this. You are preparing to take on a loan for hundreds of thousands of dollars. A loan you will be paying for the next 30 years. The difference between a 719 credit score and a 740 credit score can be a quarter point or even a half point on your interest rate. On a $400,000 loan, a quarter point difference can cost you over $20,000 in extra interest payments over the life of the loan. So the real question isn't, is it worth $40 to see my scores? The real question is it worth $40 to potentially save myself $20,000? You don't need to keep the service forever. You sign up 3 to 6 months before you plan to start house hunting. You pull your reports. You get your numbers. You see exactly what the lender will see. And if there's a problem, if one of those scores is lower than you'd like, you now have a 3 to 6 month head start to fix it. You have time to identify the issue, dispute an error, pay down a specific balance, and watch the score climb before it ever matters. It is the single most powerful tool a prospective homebuyer has. It's like being given the final exam questions 3 months before you have to take the test. Now, what about the second option? The person who might cost you a fortune. That person is a mortgage lender or broker. Yes, you can walk into their office and say, "I'd like to get pre-qualified for a loan." They will have you fill out an application, and with your permission, they will perform what's called a hard inquiry, or a hard pull on your credit. And poof, there they are. They will tell you your 3 mortgage scores for free. So why is this a potentially terrible idea? Timing. When a lender does a hard pull, it can cause your credit score to dip by a few points. It signals to the credit bureaus that you're actively seeking new debt. Now the system is smart. It knows people shop around for mortgages. So if you have multiple mortgage-related hard pulls within a short window, usually about 30 to 45 days, they are all bundled together and treated as a single event. This allows you to talk to different lenders without wrecking your score. But the key phrase there is short window. If you go to a lender for a free look in January just to see your scores, that hard pull hits your report. Then you spend the next few months working on your credit, and you go back to apply for real in May. That's a second separate hard pull. You've now taken 2 small hits to your score instead of 1. More importantly, if that first pull in January reveals a problem, the clock is already ticking. You're now in a reactive mode, scrambling to fix an issue when you should be in the driver's seat. Getting your scores from a lender first is like starting your road trip and only then looking at the map. You're already burning gas and wasting time. The FICO approach is like studying the map for weeks in your living room, finding the absolute best route, and then starting the engine with total confidence. By paying that small fee up front, you take control of the entire process. You separate the investigation phase from the application phase. You go to the lender for the first time armed with knowledge. You can walk in and say, "I've pulled my reports. My FICO 2 from Experian is a 762. My FICO 5 from Equifax is a 758. And my FICO 4 from TransUnion is a 770. My representative middle score is 762. Based on that, what kind of rate can you offer me?" The entire dynamic of the conversation shifts. You are no longer a hopeful applicant asking for a favor. You are an informed consumer negotiating a massive transaction. You are in a position of power. So you've chosen a path. You've either paid the money to FICO or you've sat down with a lender. The report is printed, or it's glowing on your screen. And there they are. The 3 numbers that will define your financial life for the next 30 years. 741, 725. And the one that's making your stomach drop, 719. The lender is going to ignore the highest and the lowest and use that number in the middle. 725. That's your number. But what if it's not good enough? What if you know deep down that you need to be at 760 to unlock the absolute best rates, the ones that save you tens of thousands of dollars? You can't just hope it goes up. You need a blueprint. You need a precise step-by-step plan. Because the tactics that boost your free Vantage score are not the same tactics that will fix a stubborn, old-school FICO score for. And getting that blueprint is exactly what we're covering in the next part. So let's build that blueprint. This isn't just a list of tips. This is a 3-phase battle plan, a surgical procedure for your credit profile, designed with one goal in mind: to satisfy the demanding old-school FICO models that stand between you and a mortgage. Phase 1: the forensic audit. I don't mean pulling your free annual credit report or checking an app on your phone. That's like a doctor diagnosing you from across the room. We need an MRI. For a mortgage, you need to see exactly what the lender sees. This means getting your full tri-merge credit report. There are services online that specialize in this for mortgage applicants. You want the report that explicitly shows you your FICO Score 2 from Experian, your FICO Score 5 from Equifax, and your FICO Score 4 from TransUnion. This is non-negotiable. It's the only way to see the 3 scores the lender will average together. Once you have this document in your hands, you're not just looking for errors. You're looking for liabilities. You're putting on your detective hat and searching for the specific items that older FICO models punish most severely. What are they? First, look at your credit utilization. This is the big one. Any card reporting a balance that's over 30% of its limit is a red flag. Any card over 50% is a 5-alarm fire. And a card that is maxed out? To a FICO Score 4, that looks like you are in severe financial distress, even if you pay the balance in full every month. The key is the reported balance on your statement date. That's the number that gets sent to the bureaus. We'll come back to how to manipulate this, but for now, just identify every single card that's over that 30% threshold. Second, hunt for collections and charge-offs, no matter how small. Remember that $20 medical copay you forgot about 5 years ago? Or that old utility bill from a college apartment? VantageScore 3.0 and the newer FICO models often ignore paid collections or small-dollar collections entirely. But FICO Score 4 does not. It sees a collection account, paid or unpaid, and it sees a breach of contract. It penalizes you for it, sometimes for the full 7 years it stays on your report. A single stupid $10 collection account from years ago can be the difference of 20 points, which could be the difference between qualifying and getting denied. List every single one you find. Third, look for late payments, specifically 30, 60, and 90-day lates. The older the late payment, the less it hurts. But a 60 or 90-day late payment, even from 3 or 4 years ago, is still a significant anchor on a FICO Score 4. A recent 30-day late can be absolutely devastating. You need to identify the date and the creditor for every single one. Finally, check the age of your accounts and the number of recent inquiries. FICO 4 loves to see long, established credit history. It gets very nervous when it sees a flurry of recent applications for new credit. This signals desperation and risk. If you've been car shopping or applying for a bunch of credit cards in the last 6 to 12 months, that's a problem we need to account for. That's the audit. You now have a detailed list of every single negative item, prioritized by what the mortgage FICO models hate the most. Now we move to Phase 2. Phase 2, Strategic Triage. This is where most people get it wrong. They get their list of debts and they start paying things off based on emotion. They'll pay off the smallest collection first for a quick psychological win, or they'll tackle the debt with the highest interest rate to save money. For everyday personal finance, that's fine. For mortgage qualification, it is a catastrophic mistake. We are not trying to win a psychological battle or even save the most money on interest right now. We are trying to gain the maximum number of FICO points in the shortest amount of time. It's a completely different game with different rules. Your first and only priority is credit card utilization. Go back to that list from the audit. Any card that is over 50% utilized is your primary target. Paying a $10,000 credit card down from $9,900 to under $5,000 will have a more immediate and dramatic positive impact on your score than paying off 10 old collection accounts. It's not even close. You want to get every single card under 30%, and your overall utilization, that's the total of all your balances divided by the total of all your limits, under 10% if possible. This is the single fastest way to boost your mortgage scores. Only after you have a plan for utilization do you look at the other negatives. And here we triage again. We focus on the collections. But which ones? You attack the newest collections first. An unpaid collection from 6 months ago is hurting you far more than one from 6 years ago. The older FICO models are all about recency. Now, here's a pro tip that can save you. Do not just go online and pay that collection account. The moment you do, you have lost all your leverage. Paying a collection does not remove it from your credit report. It simply changes the status from unpaid collection to paid collection. To a FICO Score 4, a paid collection is still a collection. It's still a major negative item. Yes, it's slightly better than unpaid, but the point gain is minimal. It does not solve the root problem. We need to get it removed. And that brings us to the most critical part of the blueprint. Phase 3, the negotiation game. This is where you go from being a victim of the credit system to an active participant. You take your list of collection accounts and you start making phone calls. But you're not calling to pay the bill. You're calling to make a deal. The strategy is called a pay for delete. You contact the collection agency, either by phone or even better, by certified mail to create a paper trail. You state that you are willing to pay the debt. Sometimes you can even negotiate for a lower amount, say 50 cents on the dollar, but only on the express written condition that they agree to completely delete the entire account from all 3 credit bureaus. You are not paying for the debt, you are paying for the deletion. Many collection agencies will tell you this is illegal or against their policy. In most cases, that is not true. They are private companies and they can choose to remove information they have furnished. You have to be persistent. You have to be firm. You tell them you will only pay if you have a signed agreement from them stating that upon receipt of payment, they will submit a request for full deletion of the trade line. If you get the agreement, you've hit a home run. Paying to have a collection deleted can boost your score by 30, 40, even 50 points or more, depending on your specific profile. Paying it without a deletion agreement might get you 5 points. It's the difference between a prime rate and a subprime rate. What about late payments? Here you use what's called a goodwill letter. If you have a long positive history with a creditor but you had one slip-up, a 30-day late payment 2 years ago, you can write to them. Explain the circumstances, acknowledge your mistake, highlight your otherwise excellent payment history with them, and politely ask for a goodwill adjustment to remove that one late payment from your record. It doesn't always work, but when it does, it's another massive point booster, and it costs you nothing but a stamp. This 3-phase process, forensic audit, strategic triage, and the negotiation game, is the blueprint. It's a systematic approach to rebuilding your credit profile with the specific goal of passing the mortgage lender's stringent review. Takes work, takes diligence. It might take a few months, but the payoff is a lower interest rate that will save you tens or even hundreds of thousands of dollars over the life of your loan. But executing this plan is only half the battle, because even if you do everything right, there is a minefield of common mistakes people make in the months, and even weeks, leading up to their closing day. These are simple, innocent-looking financial moves that can completely torpedo your mortgage application at the last second, undoing all of your hard work. And protecting you from those hidden traps is what we need to cover next. Imagine you've just run a marathon. You've trained for months, pushed through the pain, and you can see the finish line. It's right there. All you have to do is jog the last 100 yards. But in between you and that finish line is a field of hidden landmines. That is exactly what the period between your mortgage pre-approval and your closing day is like. One wrong step and everything blows up. Your financial life, which you've so carefully curated, must now be treated like a museum exhibit behind glass. Do not touch. The number one most common and most devastating mistake people make is also the most understandable. You're excited. You've found the house, you've signed the contract, and you start picturing your life there. You see the empty living room and you think, you know what would look perfect there? A brand new sectional sofa. You see the empty garage and think, finally, a good time to upgrade the car. So you head to the furniture store or the car dealership. They offer you 0% financing. It's a great deal. You sign the papers, feeling like you're getting a head start on building your new life. What you've actually just done is taken a grenade, pulled the pin, and handed it to your mortgage underwriter. Here's why. That new loan, whether it's for a $10,000 sofa or a $50,000 SUV, radically changes your financial profile. First, the store or dealership runs a hard credit inquiry. We know what that does. It dings your FICO score, even if it's just by a few points. But points matter immensely at this stage. Second, and far more importantly, you've just added a new monthly payment to your budget. This instantly throws off your debt-to-income ratio, or DTI. The DTI your lender used to approve you was based on a snapshot of your finances at a specific moment in time. By adding a new $500 a month car payment, you've just told the lender, hey, that calculation you used to determine I could afford this house? It's wrong now. And here's the secret they don't always tell you up front. Lenders do a final credit check and employment verification just before closing. Sometimes it's the day before. They call it a credit refresh. When they pull that final report and see a brand new loan and a lower FICO score, alarm bells go off. Best case scenario? Your closing is delayed for weeks while they re-verify everything and rerun the numbers. Worst case scenario? Your DTI is now too high. You no longer qualify for the loan. The deal is dead. You lose the house, you likely lose your earnest money deposit, and that new sofa is now sitting in your old apartment, a very expensive reminder of a catastrophic mistake. So rule number 1, make no major purchases. Don't buy furniture, don't buy appliances, don't buy a car, don't even buy a high-end lawnmower on a store credit card. Your wallet is closed for business until you have the keys in your hand. This leads directly to the second landmine: opening or closing any lines of credit. We've covered opening new lines with the car and sofa example, but closing accounts can be just as damaging. You might think, I'll pay off and close this old credit card I never use. That'll look good to the lender, right? It shows I'm responsible. Wrong. Can actually hurt you. A huge part of your FICO score is your credit utilization ratio, how much of your available credit you're using. By closing an account, you instantly decrease your total available credit. If you have balances on other cards, your utilization ratio suddenly shoots up, which makes your FICO score go down. You also shorten your average age of accounts, which is another key scoring factor. So hands off. Don't open anything, don't close anything. Let your credit profile sleep. The third hidden trap is one of the most sensitive: changing your employment. Your job and your income are the bedrock of your entire mortgage application. The lender approved you based on a stable, predictable, and verifiable income stream. If you quit your job to start your own business, even if you think you'll make more money, you've just become a massive risk. Self-employment income is viewed completely differently and typically requires a 2-year track record. You've just reset that clock to 0. What about just changing jobs for a better salary in the same field? Still incredibly risky. A new job means a new probationary period. It introduces uncertainty. The lender has to re-verify everything from scratch. They have to call your new HR department, get new pay stubs, and confirm your employment status. This will, at a minimum, cause serious delays. And if the underwriter feels there's any instability, maybe the new company is a startup, or your pay structure is now more commission-based, they can pull the plug. Unless you have an offer letter that is so ironclad it could survive a nuclear blast, and you've discussed it in depth with your loan officer beforehand, do not change your job. Period. Now for a mistake that feels like it's the opposite of a problem: depositing large amounts of cash. Let's say your grandma, overjoyed that you're buying a house, gives you $5,000 in cash as a housewarming gift. You gratefully take it to the bank and deposit it. To you it's a gift. To a mortgage underwriter, it's a giant, flashing red flag with a siren attached. Why? Because all the money for your down payment and closing costs must be sourced and seasoned. That means the lender has to know exactly where every dollar came from, and they need to see that it's been sitting in your account for a while, typically at least 60 days. A large, sudden cash deposit is what they call mattress money. They have no idea where it came from. Is it a loan from a friend that you're not disclosing? That would be a new debt that messes up your DTI. Is it from an illegal source? They are legally required to track this stuff under federal anti-money laundering laws. If you deposit a big chunk of cash, you trigger a massive paperwork nightmare. You'll need to provide a gift letter from your grandma, she'll need to provide a bank statement showing the money leaving her account, and the whole process gets bogged down in verification. The simple rule is, do not deposit any cash that isn't from your regular paycheck. If you receive a gift, talk to your loan officer first. They will tell you the exact, precise procedure to follow to document it properly, so it doesn't derail your entire application. Finally, a trap that snares the kind-hearted: co-signing a loan for someone else. Your brother needs a new car, and his credit isn't great. He asks you to co-sign. You're in a good mood, you're about to buy a house, you want to help him out. You sign the paperwork. You have just legally taken on 100% of the responsibility for that debt. Even if your brother makes every single payment on time, that loan now appears on your credit report. It's part of your DTI. When your lender does their final credit refresh, that new loan pops up out of nowhere. It's the same exact problem as if you bought the car for yourself. Your DTI is shot, and your mortgage is in jeopardy. You cannot be a financial hero for anyone else while you are in the mortgage process. Your only responsibility is to your own application. Each of these missteps, making big purchases, altering credit lines, changing jobs, depositing mysterious cash, or co-signing, stems from the same fundamental misunderstanding. People think that once they have the pre-approval letter, the deal is basically done. It is not. The pre-approval is just the ticket to get into the stadium. You still have to play the entire game. And during this game, the rules are simple but strict. Your financial life must be a flat line. No spikes, no dips, no changes. The person the underwriter approved on day one must be the exact same person, financially speaking, on closing day. Any deviation creates a problem that you do not have the time or the leverage to solve. But what happens when the underwriter themselves starts asking for more, digging deeper right before the finish line? That final underwriting check can be the most stressful part of the entire journey, and navigating its demands is our next critical subject. This is the moment the game changes. You've been playing offense the whole time, gathering documents, improving your score, getting pre-approved. But now you're on defense. The underwriter is the final gatekeeper, the person in a quiet office you'll never meet, who holds the fate of your loan in their hands. Their job isn't to be your friend. Their job is to protect the lender's massive investment. They are looking for one thing, a reason to say no. Any sign of increased risk, any inconsistency, any shadow of a doubt that has emerged since your initial application. This isn't a redo of the whole process. It's a high-stakes spot check. Think of it as the final security scan before you board the plane. They're not re-inspecting all your luggage, but they are looking for anything that seems out of place right now. The first and most terrifying check is the verification of employment, or VOE. Yes, they already did this, but they will do it again, often within 24 to 48 hours of your closing date. They will literally call your employer's HR department one last time to ask two simple questions. Is this person still employed here? And is their employment status the same? Imagine the sheer terror of that. You're 3 days from getting the keys, you've already scheduled the movers, and an underwriter makes a call. What if you just got a promotion? Great, but if it hasn't been documented properly and communicated to your lender, it could cause a delay. What if your company just went through a round of layoffs and you survived, but the HR contact is new and can't find your file immediately? Delay. What if, and this is the nightmare scenario, you lost your job between the initial approval and the closing date? The loan is dead. Instantly. It doesn't matter if you have another job lined up. The entire application was based on the income and stability of the job you had. A new job means a new application from scratch. This is why mortgage professionals beg their clients: do not quit your job, do not change jobs, do not even think about altering your employment situation without talking to your loan officer first. That last-minute phone call is a pass/fail test, and the stakes couldn't be higher. Next up is the final credit check. This is often called a credit refresh or a soft pull. It's not a full score-damaging hard inquiry, but it gives the underwriter a snapshot of your credit report right now. What are they looking for? They're scanning for changes that scream new risk. Did you suddenly open a new credit card? Did you finance a new sofa and love seat for the home you don't even own yet? Did you go out and buy a new car because you figured, hey, I'm already approved for the house? This is, without a doubt, the single most common and catastrophic mistake buyers make. Let me tell you about Sarah. Sarah was a week from closing on her first condo. She had a 760 FICO score, a stable job, and had been pre-approved with flying colors. Her debt-to-income ratio was a healthy 38%. She was golden. But her 10-year-old car finally gave up the ghost. She thought, I need a reliable car to get to my job, the job that's paying for this mortgage. It's a responsible thing to do. So she went to a dealership, found a modest sedan, and took out a $500 a month car loan. She didn't tell her loan officer because why would she? Seemed completely unrelated. For days before closing, the underwriter ran the credit refresh. And there it was. A brand new hard inquiry and a new installment loan for $25,000. That $500 monthly payment shot her debt-to-income ratio up from 38% to 44%. The lender's cutoff was 43%. The underwriter saw this new, undisclosed debt and hit the brakes. The loan was suspended. Sarah was in a full-blown panic. Her rate lock was about to expire, the sellers were threatening to walk, and her dream was evaporating because of a car she thought she needed. It took a frantic, last-ditch effort from her loan officer, involving Sarah's parents paying off a small credit card balance to slightly lower her DTI, to salvage the deal. She barely made it, but the stress nearly broke her. The rule is absolute. From the moment you apply for a mortgage until the moment the keys are in your hand, your credit is in a cryogenic freeze. You do not apply for anything. You do not open new accounts. You do not co-sign for anyone. You do not let anyone run your credit. You become a ghost in the credit system. The third area of intense scrutiny is your bank accounts. The underwriter will ask for your most recent, up-to-the-minute bank statements. They are hunting for undisclosed large deposits. Why do they care if you have more money? because they need to know where it came from. Federal anti-money laundering regulations are one reason, but the bigger concern for the loan is that the deposit might be a secret loan. If your uncle gave you $20,000 for your down payment, that's wonderful. But if he expects you to pay it back, that's a $20,000 debt with a monthly payment that you didn't disclose on your application. That's fraud, and it completely changes your debt-to-income calculation. Any large, non-payroll deposit will be flagged, and you will be required to provide a letter of explanation. You'll have to document the source of every single dollar. If it's a gift from a relative, they will need a signed gift letter from that person stating that the money is a true gift and no repayment is expected, along with a copy of the check and a bank statement from the giver showing the funds leaving their account. This feels incredibly invasive, but it's non-negotiable. The underwriter must be able to paper trail every cent of your down payment and closing costs to ensure it's your money or a legitimate, documented gift. The best way to handle this? If you know you're receiving a gift, tell your loan officer the moment you apply. Don't just deposit a check for $10,000 and hope nobody notices. They will notice. Being proactive and sourcing the funds properly from the very beginning saves you a world of pain and frantic paperwork right before the finish line. So, how do you navigate this final trial by fire? The strategy is simple: stability and communication. Be a statue. Don't change your job, your credit, or your banking patterns. If a change is unavoidable, like a necessary job change that actually improves your income, you must communicate it to your loan officer the second it happens, not a week before closing. They can work to get it approved and documented upfront, but they can't work miracles at the last minute. And be hyper-responsive. When the underwriter asks for that extra pay stub or that letter explaining a deposit, they don't mean get it to them by the end of the week. They mean get it to them now. Your file is on their desk for a very short window. If you delay, it goes to the bottom of the pile, and every day you wait, you risk your rate lock expiring, which could cost you thousands of dollars over the life of the loan. Have everything scanned and ready to email at a moment's notice. Your FICO score itself isn't usually recalculated at this stage, but all the behaviors that could destroy your score are what the underwriter is looking for on that credit refresh. A new collection account, a maxed out credit card, a newly missed payment. These are the red flags that will bring the entire process to a screeching halt. The discipline you used to build a great FICO score is the exact same discipline you need to get through final underwriting. Consistency. Stability. No surprises. Once you satisfy every last condition, once every piece of paper is in place and every question is answered, you will receive 3 of the most beautiful words in the English language: clear to close. This is the official green light. It means the underwriter has given their final sign-off, and the lender is fully committed to funding your loan. But getting that clearance triggers the final frantic sprint to the finish line. A cascade of numbers, documents, and wire transfers. It's time to understand the closing disclosure, the final math that tells you exactly how much money you need to bring to the table to finally make that home your own. This document, the closing disclosure, isn't just another piece of paper in the blizzard of paperwork you've been navigating. It is the final legally binding receipt for the single largest purchase of your life. Think of it as the financial blueprint of your homeownership. For years, the final numbers in a mortgage were a bit of a Wild West situation, often changing dramatically at the last second, leaving buyers shocked and scrambling for cash at the closing table. But thanks to a federal rule, often called the Know Before You Owe rule, lenders are now required to give you this document at least 3 full business days before your scheduled closing. This isn't a suggestion, it's your right. It's a mandatory cooling-off period designed to give you the power to review every single number, ask questions, and ensure there are no surprises. This 3-day window is your shield. So let's unsheath this sword and learn how to use it. When you open that 5-page document, the first page is your executive summary. It's designed to give you the most critical information at a glance. Up top, you'll see the loan terms, the final loan amount, your interest rate, and your monthly principal and interest payment. That interest rate, sitting right there in black and white, is the direct descendant of the FICO score we've been talking about this entire series. A 780 FICO versus a 680 FICO could be the difference of tens of thousands of dollars in interest over the life of the loan. And this is where that reality is etched in stone. Below that, you'll find your projected payments, which includes not just the principal and interest, but also an estimate for your homeowner's insurance and property taxes. This is your PITI, the all-in number you'll actually be paying each month. But the number that makes everyone's heartbeat a little faster is on the bottom right. Cash to close. This is the final definitive amount of money you need to bring to the closing table. It's the culmination of your down payment, plus all your closing costs, minus any deposits you've already paid. This is the number you'll be wiring. Now turn to page 2. This is where the magic and the confusion often happens. This page is a detailed, itemized breakdown of all those closing costs. It's split into sections. Section A is origination charges. This is what you're paying your lender for the service of creating your loan. You'll see things like an application fee, an underwriting fee, and points if you chose to pay them to lower your interest rate. These are the lender's direct costs. Section B lists services you couldn't shop for. These are third-party fees for essential services that the lender chooses, like the appraisal fee, the credit report fee, and a flood determination fee to see if your new home is in a flood zone. You had to pay them, but you didn't have a choice in the provider. But then there's Section C. This is crucial. These are services you could have shopped for. This is where you'll find things like the title insurance fees, a survey fee if one was needed, and pest inspection fees. The law gives you the right to choose your own providers for these services. If you simply went with the lender's recommendation, that's fine, but savvy buyers know they can save hundreds, sometimes thousands of dollars, by getting quotes for things like title services from different companies. This section is a reminder of the power you have as a consumer in this process. As we move down the page, you'll see other costs like government recording charges, the fee the county charges to officially record your deed and mortgage, and transfer taxes, which is the tax the state or city slaps on the sale of a property. Then you hit the prepaids. This section often trips people up. You'll be prepaying for your first year of homeowner's insurance. You'll also be prepaying for any property taxes that are due. And you'll see a line for prepaid interest. This is the interest that accrues on your loan from the day you close until the end of that month. Because your first official mortgage payment isn't due until the first of the following month, the lender needs to collect this little stub of interest up front. Finally, you'll see your initial escrow payment. This is the seed money for your escrow account. That special savings account your lender will manage to pay your property taxes and homeowner's insurance on your behalf throughout the year. They collect a little bit with each mortgage payment, but they need a cushion to start with, and this is where you provide it. Now, here is the most important action you will take during your 3-day review period. Find the very first document your lender ever gave you, the loan estimate. Place it side by side with your closing disclosure. The entire purpose of this new system is to make this comparison easy. The forms are designed to look almost identical. Your job is to be a detective. Compare the numbers line by line. The fees in Section A, the lender's origination charges, have a zero tolerance rule. They cannot legally increase from your loan estimate to your closing disclosure, period. If they have, you need to call your loan officer immediately. The fees in Section B, the third-party services you couldn't shop for, have a 10% tolerance. They can't increase by more than 10% in total. But the fees in Section C, the ones you could shop for, have unlimited tolerance because if you chose a more expensive provider, that's on you. By comparing these two documents, you are auditing your own loan. You are making sure you weren't a victim of a bait and switch. You are taking control. If you see a fee you don't understand, or a charge that seems to have appeared out of nowhere, pick up the phone. Call your loan officer. Call your real estate agent. Call your attorney. Do not be shy. You are about to make the biggest financial commitment of your life, and you have a federally protected right to understand every single penny of it. This 3-day window is your moment to get clarity and challenge anything that seems wrong. Once you've reviewed the closing disclosure, you're satisfied with the numbers, and you've signed it, the clock starts ticking towards the finish line. Your lender will work with the title company to finalize the numbers, and you'll receive the official clear to close. This is the green light. It's the moment the lender officially says, "We are ready to fund this loan." At this point, you will receive final instructions for your wire transfer. And this is where I need you to listen very, very carefully. Wire fraud is rampant in the real estate industry. Scammers will create fake emails that look exactly like they're from your title company or attorney, with their own fraudulent account numbers. If you send your life savings to them, it is gone forever. You must never trust wiring instructions sent via email. You must pick up the phone and call the title company or attorney using a phone number you sourced independently from their official website or a business card you were given in person. Verbally confirm the account number and routing number with a live person before you initiate that transfer. Do not skip this step. It is the single most important thing you can do to protect your down payment. The money is on its way. The appointment is on the calendar. You're about to walk into a room with a stack of paper taller than a phone book, And at the end of it, a set of keys will be placed in your hand. This is the closing table, the final act of a long and complex play, where your signature turns a dream into a deed. And as you sit there, pen in hand, you realize this isn't just about signing documents. It's about taking on a legacy. Each signature is a promise to the lender, yes, but more importantly, a promise to yourself. A promise to build, to grow, to create a sanctuary. The title agent, the lawyers, the real estate agents, they all become a blur. The only thing in focus is the paper in front of you, the ink flowing from your pen, writing the next chapter of your life into existence. And then it's over. The mountain of paper is pushed aside. A hand reaches across the table, and in it, a small, simple set of metal keys. They feel impossibly light for the weight they represent. This is it. This is the moment, the entire journey, every late-night budget session, every credit report check, every single point you fought for on your FICO score was for. You've crossed the finish line. But here's the secret no one tells you at the closing table. This isn't the end of the race. It's the starting gun for a new one. The roll of your FICO score doesn't vanish the moment you get the keys. It transforms. Before, your score was a gatekeeper. It determined whether you could even enter the world of homeownership. Now it becomes your report card. Your mortgage is now the single largest, most significant trade line that will ever appear on your credit report. For the next 15 or 30 years, this one monthly payment will be the bedrock of your financial reputation. Think about it. Every on-time payment is a powerful, positive signal sent to the credit bureaus. It's you month after month telling the financial world, I keep my promises. I am reliable. I am a good risk. Consistently paying your mortgage on time is the single most effective way to build and maintain an elite-tier credit score. It demonstrates a level of financial stability that very few other things can. Conversely, a late mortgage payment is a financial earthquake. It's not like being a few days late on a credit card. A 30-day late mortgage payment can drop your FICO score by a staggering 60 to 100 points, or even more. It's a giant red flag to any future lender, signaling distress at the most fundamental level. For years, that one late payment can haunt you, making it harder and more expensive to refinance, get a car loan, or even get a new credit card. The stakes are now higher than they have ever been. Your home is both your greatest asset and your greatest liability, and how you manage it will write the story of your financial future. This brings us to what I call the new homeowner's million-dollar mistake. You've got the keys, you walk into your new empty house. The floors gleam, the walls are blank canvases, and the immediate, overwhelming temptation is to fill it. The new sofa, the big screen TV, the dining room set, the bedroom furniture. And right on cue, the mail starts arriving. Pre-approved credit card offers. 0% financing from furniture stores. Feels like free money. Feels like you deserve it after the grueling mortgage process. This is a trap. A devastatingly effective trap. Going on a major spending spree right after closing on a house is one of the fastest ways to torpedo your financial health. You've just taken on the largest debt of your life. Your debt-to-income ratio is likely stretched thin. Loading up on thousands of dollars of new consumer debt at this exact moment is like trying to run a marathon with a backpack full of rocks. It instantly increases your credit utilization, which damages your FICO score. It adds multiple new monthly payments to a budget that is already strained with a new mortgage payment, property taxes, and homeowner's insurance. And it creates a cycle of debt that can become impossible to escape, putting the most important asset you own, your home, at risk. The smart move? Live in the empty space for a while. Get used to the new budget. Use the furniture you have. Save up cash for the things you want. Furnish your home slowly, deliberately, and without debt. Your FICO score and your peace of mind will thank you for it. As we look back on this entire journey, from understanding the 5 pillars of your FICO score to sitting at the closing table, it all boils down to 3 fundamental truths. First, your FICO score is not a grade. It's your financial autobiography. It's a living document that tells the story of your decisions, your habits, and your discipline. It's not something that happens to you. It's something you actively write every single day, with every payment you make and every line of credit you open. You are the author. You hold the pen. You can revise the story at any time. The second truth is that the mortgage process is a test of preparation, not a game of luck. People who get the best terms aren't lucky. They're diligent. They start preparing months, even years in advance. They treat their credit report like a prized garden, carefully tending to it, pulling the weeds of inaccuracies, and nurturing it with on-time payments and responsible usage. They don't wait for the lender to tell them there's a problem. They find and fix the problems themselves long before they ever fill out an application. They understand that the underwriter isn't an adversary. They're a risk assessor looking for a story of stability, and they hand them a masterpiece. And the third and most important truth is that homeownership is the beginning of a new responsibility, not the end of a struggle. The keys in your hand are not a trophy. They are a tool to build equity, a tool to create a stable environment for your family, a tool to plant roots in a community. Every mortgage payment you make is a forced savings account, converting a portion of your debt into tangible wealth, your home equity. This is how generational wealth is built in America, not through get-rich-quick schemes, but through the slow, steady, unglamorous process of paying down a mortgage on a home that, over time, appreciates in value. Your FICO score got you in the door, but it's your discipline as a homeowner that will build the wealth. So what now? Where do you go from here? Whether you're years away from buying a home, or you're preparing to apply next month, the first step is the same. You need to know your story. You need to look at your credit report, not with fear or judgment, but with the critical eye of an editor. What story does it tell right now? Is it a story of consistency and reliability? Or is it a story of missed opportunities and chaos? Whatever it is, own it. And then decide what you want the next chapter to be. Start with one small positive change. Set up autopay for all your bills to ensure you're never late. Pay down your highest interest credit card by an extra $20 a month. Dispute that old inaccurate collection account that's been dragging you down. Each action is a new sentence in your financial autobiography. The FICO score seems like this big, mysterious, intimidating number. But in the end, it's just a reflection of your habits. It's a tool. And like any tool, its power lies not in the tool itself, but in the hands of the person who wields it. The journey to homeownership is more than a financial transaction. It's a journey of self-discipline, of foresight, and of commitment. It's about proving to a lender, and more importantly to yourself, that you are ready for the responsibility and the reward. The American dream isn't about simply owning a house. It's about building a life. And it starts with understanding the rules, playing the game with intention, and writing a story of financial strength, 1.1 payment, 1 month at a time. The keys are waiting. Go earn them.